Thank you for joining Market News with Rodney Lake. This is a regular program for the GW Investment Institute, where we talk about timely market topics. I'm Rodney Lake, the director of the GW Investment Institute. Let's get started. Welcome back to Market News with Rodney Lake. I'm your host, Rodney Lake. We're coming to you from the GW, George Washington University School of Business, Duquesne Hall, Duquesne Family Studio, right here in the heart of Foggy Bottom. Welcome back to our viewers who have tuned in before, and welcome to any new viewers if you're watching on YouTube. If you're listening on Apple, Spotify, Amazon, welcome and welcome back. All right, we're jumping into some broad market by popular demand. This episode will be not about an individual company, but about what's happening in the market. And I'm going to date this episode so that you know as of when. So today is August 12th, 2025, and there's tons of news to cover. And this is what we do at the beginning of our classes. This is a GW Investment Institute podcast, and we cover student investment funds at the Investment Institute, and our students manage those funds, and we train them to do that. Every class, what we kick off with is market news, hence the name Market News with Rodney Lake. So today's episode is going to be a little bit about what we do at the beginning of class with today's news. And there is a lot of news. And as an investor, as a business person, as an analyst, you should be doing this all the time. Digesting news, see what's going on, setting up different AI agents for yourself to track different parts of the news, different economic indicators. But there's so much stuff going on. There's no shortage of information. We'll have to decide, as every good analyst, what we should include in today's episode. But at the top of the show, for market news today, again, this is August 12th, 2025. Has to be the CPI numbers that came out this morning. All right, CPI numbers, goods inflation more subdued, services picked up, but really the reaction from the market is pretty positive. So the market is up today. The NASDAQ, you're hitting all-time highs, really. But overall, market is up, and we'll get into a little bit about where the overall levels of the market, especially with relative to valuation, are right now. But if you look at the CPI numbers, not bad at all. You're certainly not a huge concern. The consumer price index increased 0.3% from June, in line with economists' forecast, with the pickup really from services, including airfare, medical care, and recreation. So really not a bad number. And it looks like the market is taking it very much into stride. So it doesn't seem to be a big issue. The PPI numbers will come out soon. And so certainly as an analyst, you should be tracking those things and see what's happening. The consumer price index is really the focus on the inflation piece here. Obviously, the PPI is important, producer price index, but the CPI is looking to that. Now, why is the market having this reaction? Well, one of those reasons could be that, inflation certainly maybe not as low as people would like, but these numbers would increase the probability for the Fed to cut rates. And it looks like, they paused, and that's something to talk about as well, that the last time they met in July, there was a pause. The President Trump is obviously, if you've been watching the news at all, has been really pushing for a rate cut and saying that inflation is under control. Any of these tariff concerns are going to be a one-time blip. It's not going to be a long-term inflationary problem. They stopped short of using the word transitory because the Fed made a mistake with that verbiage long ago. That said, it looks like inflation is under control. The tariffs definitely don't seem to be quite as bad as people made them out. Certainly, if you look back towards what was called Liberation Day, when they were first announced, and the market really panicked and thought, well, these numbers are really crazy in some cases and absurd, and these levels are going to shut down trade, which they did for a short period of time, for example, on China effectively. And that's something to mention today, too, that the U.S. and China agreed to extend 90 days, the effective truce, to keep negotiating. So that's also good news for the market, and the market is digesting that as well. But the overall sentiment with that, if you account for what's happening in the CPI level, what people think then the expectations for the Fed lowering rates in September, which seems to be very high right now, and more rates possibly to come, which is good news for sectors like housing, for example. So for those first-time home buyers who are looking to get lower interest rates, so they can afford more of a house, right? And then obviously there is a race there between prices and interest rates as always, they work inverse, right? Lower discount rate, higher price, the same as a bond, for example. But in the short term, if you can get lower interest rates and people get some affordability that's priced into that, that's good to unlock the housing market. So what does that do? That unlocks other sectors, construction, lumber, all the things. If you think about, as an analyst, you think about what goes into a house: copper, plastic, wood, construction, labor, all these things, concrete, have to go into build a house. And so those are all good things, right? And people working to do that, and people getting homes, and people investing in their homes. And so those are all good things to drive the economy forward. And it's a big part, and can be even a bigger part of the overall economy. But with these interest rates where they are, if you're getting a 30-year mortgage and you're touching 7%, that's historically not terrible if you're talking about versus the 80s. But from the recent past, that's not great. And certainly that affordability gets more challenging when you already had higher prices. And so, the fewer and fewer people can afford the loans to cover those prices. And so I think the goal is to get those interest rates down. 4.25%, 4.5% is the target right now from the Fed. And again, the president's been leaning on the Fed and the Fed Chairman Powell to reduce those interest rates. But again, the CPI numbers came out. They certainly look mostly in line. And certainly not a concern right now for the market. So the market is taking them into stride. The market is up today. If you look at just the broad-based numbers, the Dow's up over 1%. The S&P is up 71 basis points. And the NASDAQ is up 78 basis points. And so all good. And this is kind of in the morning on August 12th, 2025. And so those things could change by the close of market when we're recording this earlier in the day. But again, the market has had time already to react to these numbers. They came out this morning at 8:30. It's 11 o'clock now. And so the market does seem to be taking these CPI numbers into stride. You also have the announcement for China and the U.S. saying that we're going to pause right now for another 90 days. Let's continue to negotiate. That's generally good news. It seems like cooler heads prevailing on the tariff talks between the two countries. So that is good. While we're here with China, you also got a deal from the White House to let both NVIDIA and AMD to sell later generation chips, H20s, for example, for NVIDIA to China, paying basically a effective tariff or tax on those chips of 15%, which some people are unhappy with. Now, China's pushing back a little bit, saying, that there's backdoors in those, and NVIDIA's releasing statements that there's not. And so there's a little bit of back and forth right now happening with this. We'll see where the dust settles from that. The H20 chips are a later generation chip. The Blackwells, not the same as the Blackwells, but certainly very good chips, and probably still better than many of the chips that China can produce on its own. And so even a later generation is probably still worth having. And they're probably going to have good sales associated with those chips, both the later generation AMD and certainly from the H20s from NVIDIA, because AI is the name of the game. And so when we talk about AI, we'll stick with that. Obviously, NVIDIA has been the story. We've covered NVIDIA on the podcast, and we'll continue to cover NVIDIA, by the way. So we will have more episodes coming up about NVIDIA specifically. It is and continues to be the largest holding for the GW Investment Institute. So it's something that we watch. A couple of our summer interns, shout out to Paige and Victor this summer. Thank you for doing work on NVIDIA for us. And so it's something that we have to pay attention to. It's something that we have to watch and be ready to always, understand how things are changing. What is the situation? Again, it's a big holding. Stan Druckenmiller, for example, is that, you concentrate your bets. You put your eggs in one basket and you watch that really closely. And that's the case with a few of our positions, NVIDIA being the largest. So we're watching that very closely. So in the AI world, that continues to be a big push, the training, the amount of money that's going in. If you look at the CapEx budgets for people like Meta, Amazon, Microsoft, they're continuing to put big numbers up, tens of billions of dollars that's going into the AI spend and the AI build out, including data centers. Power is becoming an issue. You saw, if you follow the program here, that we did an episode on Emerson, a supplier into the electric market. And so you got to think about other derivative ways to play this AI game, and power is going to be, maybe a constraining point for this world that we're building out that's all AI. So some things to think about there are, are there other derivative plays? Obviously, people are already onto the data centers, and people are certainly already thinking about what it means for electricity supply and nuclear and other things. Constellation comes to mind there. So what else is happening in AI? You have also the real world AI. Tesla comes to mind here. You have Waymo, and now Tesla running, Tesla's version is called robotaxis. Waymo's is the autonomous taxis that are running in different cities. Waymo's in San Francisco and Phoenix and other spots. And now Tesla has the robotaxis running now in Austin and in the Bay Area. Now, they're not fully autonomous. They do have the safety drivers or the safety riders that are not necessarily driving the car. And in the case of Austin, they're sitting in the passenger seat. So still testing it. Their geofence, so the location is not as big as it can be. It's not unlimited for both companies right now. The solutions are different, though. That's something as an analyst to think about and watch. Is the solution for Tesla is a camera-based system, not LiDAR, and ultimately not a geofenced area, whereas with Waymo, which is owned by Google, is a geofenced area with LiDAR. And so the equipment on the car is very expensive. And so with Tesla, they're looking to drive the cost down. Any production car, the Model Y, is what they're using right now for those robo-taxis. So that is an example of real-world AI. And I think this is going to continue to be the case. And as analysts, business people, investors, you're going to have to continue to watch and what are the implications for this real-world AI. Now, obviously, for a company like Uber, that's a big shot across the bow. And as an analyst, you got to be thinking about that. We don't own shares in Uber as part of the investment institute. Reminder, this is educational and entertainment purposes only, not investment advice. We don't own shares of Uber, and if we did, we would be really paying close attention, even closer than we are now, of what's happening here. What are the impacts? Now, Uber recently has announced pretty good data, and Lyft. If you owned either one of these companies, we don't own either one, you should be thinking about that, right? What are the implications for this real-world AI for those companies? Obviously, maybe they can take advantage of that. Maybe they can pivot. And one of the most expensive parts of their equation are the drivers. Maybe they can be in the autonomous business. They certainly already have, for example, Uber with the combination with Waymo, and in some locations that's how you actually book the ride with Waymo is through the Uber app. So they can have these partnerships. They can be figuring that out. Certainly, they control less of the economics. They control less of their destiny if they don't have their own solution. Long ago, you might remember that Uber was building out their own autonomous driving with a lot of scientists out of Carnegie Mellon, as an example, in Pittsburgh. And so we'll have to see how this goes. But you should be paying close attention to all this real world. The other part of that is the robotics piece, the real world AI. Optimus, obviously, from Tesla, but you're also having, robots. Lots of Chinese companies have their humanoid robots. And so I think that's going to be a competitive market. And certainly if you can buy an autonomous robot that can do your laundry, clean your floors, clean your house, and do all these things for $30K, and you can finance it, lots of people are going to have an autonomous robot to help them out with all those types of chores. And obviously, if you can have an autonomous car that can go pick up your kids, can be on the network, drives you to work, and then does rides and becomes a cash flow generator. That's a very different model than what happens right now with cars. And so the world, you can see, is likely going to change as a result of how these things play out. And again, as a business person, as an analyst, as an investor, you really have to think through not just what's happening today, but what are the implications for these things both today, tomorrow, and really a year from now, 5 years from now. How do we think these things are going to play out? And then how do we position our portfolio to make sure that, one, we take advantage of those, but also that we get out of the way of some of these things? And so when you look at, for example, Bank of America has started to put out a list of companies that are at risk. What are the companies at risk? Companies like Wix and Shutterstock and Adobe. So if you look at those types of companies where AI is maybe, for example, on Adobe, we did a recent episode on Adobe. If really they're at risk and you're going to have AI be deployed where you have all these tools and you just really type in, like for example, in the large language model, but on the creative side, where you really don't need Adobe to help create things. You don't need people that are experts in that software. You just need people to describe what they're looking for. Well, certainly there's still going to be a market for designers and people that have an eye for design. But the tools that they use are likely to change. Figma, for example, went public recently. Ticker is FIG. We don't own that. But that's obviously a big threat for Adobe, and Adobe tried to buy it previously. But that can be a big threat. And so, again, I encourage you to also watch not just Bank of America's list, but what do you think some of these enterprise software companies people talk about too, like Salesforce and ServiceNow, which we've done episodes on those, and we own those companies. So you have to really think about what are the implications? Where are the opportunities, but where also are the risks, and especially for the companies that you own. So if you own these companies, like we own ServiceNow and we own Ticker CRM, which is Salesforce, what's the future? Mark Benioff, the CEO of Salesforce, has been pushing back and saying, well, there's still going to be at the enterprise level room for a company for Salesforce. Now, he's talking his book, obviously, but we have to figure out whether we agree with him on that or whether we disagree. And where we disagree, how's it going to show up? Maybe he's genuinely right, but maybe not even for the right reasons. Who knows? Or for the reasons, rather, that he says, not right or wrong. So as an analyst, what's happening in the AI? We got to figure that out. And that's something I think that's going to be a fundamental shift in many of our portfolio companies. And we really have to pay close attention to those companies that are at risk that we own. And we really have to pay close attention to the companies that continue to provide opportunities. At the top of that list, obviously, has been NVIDIA. But you also have companies like Microsoft that we'll just talk about for a moment that's been driving really hard in the AI game. They own a big stake in OpenAI. That continues to be a complicated situation. And we'll see how that plays out. And there's possibly, I don't know if it's friction, but we'll see how these two effectively competitors in some areas, how this works out between OpenAI and Microsoft. Microsoft's Azure, which is their cloud business, has been growing. It grew 30% if you saw the last quarter. And it's already a very big business, not as big as AWS, but very big. And AWS for Amazon also grew almost 18%. And it's a huge business. And so these cloud providers who can deploy things at scale. And so they really, if you think about, okay, well, who can deploy AI at scale? Well, CRM, ticker Salesforce could, but if it really doesn't help their business model and lots of people figure out ways around it, are they going to be able to, charge as much for their products? Well, maybe not. And so something to consider is also, well, there could also be a shift in the way that these things are priced. And you're already seeing that in a company like Adobe, which we talked about, and you look at the multiple on Adobe where it is now. Obviously, that's come down. They have super high gross margins, but the market perceived that this is under threat. And if it is, okay, well, maybe they're going to continue to have earnings. Maybe they'll continue to find a way forward, but the multiple on their business, and you're already seeing it, has started to come down. And maybe that's the market has already started to anticipate that and saying that those earnings are not worth as much as they were 5 years ago because they're going to be disintermediated, and maybe we don't know the reason or the way, rather how, but they're going to be disintermediated. So the multiple on those companies needs to come down, and so you got to be careful about that, right? The Davis double play is you make money by growth in earnings and a re-rating upward on the multiple. The same, the reverse can happen to you on the negative, which is earnings flat or decline, and you get a re-rating downward, which means losing money. And you get a re-rating downward, and it's becomes a permanent or at least semi-permanent, meaning it's over a few years. You're getting towards permanent loss of capital if that's the case. If you're not nimble enough to move in and out of those positions, and so you got to be careful about that. We're long-term investors, so we're not trying to time the market to be super clear. We're looking for long-term investments. We're looking for fantastic companies. So we talk about the model that we use, the framework, business management, price, valuation, and balance sheet. We've been talking a lot about how AI impacts the business. Then clearly management needs to figure out how to better position those companies that are at risk and continue for the companies that are doing well. How do they continue to be in the right place? That valuation that we mentioned, those companies like Adobe that are getting that re-rating downward, we got to be at least aware of that, what's going on. And of course, what's the risk on the balance sheet? At the Investment Institute, at GW, we're equity investors. We don't own debt in these companies. And so we have to think about what's the capital structure, who's ahead of us, in the legal stack there. The equity is at the bottom and debt would be ahead of us. And so net cash always helps us sleep better at night. It makes us feel good. And so we need to think about all those things. And again, just to wrap up for this episode of a general market overview, CPI numbers, not, maybe not as low as people want, but certainly the market taking those in stride and effectively in line with expectations. The market, again, this is kind of towards midday on August 12th, 2025. The market's absolutely taking those numbers in stride and, generally taking it as good news moving forward. The China-U.S. truce continues 90 days to keep negotiating on the tariffs. The tariffs don't seem to be a huge impact, again, on the CPI numbers. PPI coming tomorrow. And watch what's happening on the AI front, the AI game. Make sure you know the companies that are best positioned to take advantage, and make sure you're watching the companies that are at risk. We certainly will be in the semester. We'll be starting very soon, and our analysts will be getting to work on our portfolios. Until the next time, we'll see you back here on Market News with Rodney Lake. Thank you. Disclaimer, the content shared in the GW Investment Institute podcast is for informational and educational purposes only and should not be considered investment advice. The opinions expressed in this podcast are those of the host and guest and do not necessarily reflect the views of the GW Investment Institute or the George Washington University. Listeners should not act upon the information provided without seeking professional advice from a qualified financial advisor. Investing involves risks, including the loss of principal. The GW Investment Institute, the George Washington University, and the podcast hosts do not assume any responsibility for any investment decisions made based on the content of this podcast. Always conduct your own research and consult with a financial advisor before making any investment decisions.